So let's just get right into it. You've seen the headlines, right? They are screaming panic. A major oil choke point is in trouble, and it really feels like the whole global economy is teetering on the edge. But if you actually look at the markets, something seems off. The reaction doesn't quite match the headlines, and we're going to break down why.
And look, these headlines are no joke. We are talking about the Strait of Hormuz. A mind-boggling 20% of the entire planet's oil supply flows through this one narrow waterway. So when you hear that it's being disrupted, your brain instantly goes to, those 1970s gas lines and a full-blown crisis.
And yet, they're not. I mean, sure, prices have definitely jumped, but they haven't exploded. We haven't seen that runaway, out-of-control panic you might expect. So what gives? This is the big puzzle we're going to solve today. What is the market seeing that the headlines are missing? And that really gets to the heart of what we're talking about today, this huge gap between the headline hysteria and what's actually happening on the ground in the market. The market isn't broken, and it's definitely not ignoring the risk. It's just looking at it in a much more specific and, honestly, a much more sophisticated way. So here's the absolute key. Traders and the market as a whole, they are 100% treating this as a serious geopolitical crisis. But, and this is a big but, they're drawing a very clear line in the sand between a crisis, which is scary but manageable, and a catastrophe, which would literally break the system. Right now, everything is pointing towards it being just a crisis. So how is the system actually managing this? Well, as it turns out, the global oil market has these incredible built-in shock absorbers. Think of them as 4 hidden lines of defense that are soaking up the initial impact way better than most people think. Let's run through them. First up, you've got pre-positioned supply. There are massive stockpiles of oil around the world, basically acting like a giant emergency fuel tank. Second, there are alternative pipelines. Big producers like the UAE can actually ship some of their oil by bypassing the Strait of Hormuz completely. Third, the timing was pretty fortunate, believe it or not. We're in what's called a shoulder season, that sweet spot between winter and summer when global oil demand is naturally a bit lower. And finally, the market wasn't totally blindsided. Traders already had a certain fear premium baked into the price, which helped cushion the blow when it finally came. And these buffers are doing some serious heavy lifting. I mean, we're talking about as much as 15 million barrels of crude per day being taken offline, even if just temporarily. The fact that oil prices haven't shot to the moon with a number like that hanging out there, well, it just shows you how effective these shock absorbers really are. And this right here, this gets to the single most important factor the market is watching: duration. How long is this going to last? Because a short disruption, something that lasts a few weeks, that's just a stressful event. It creates a lot of volatility, a lot of chop, but it's manageable. But a prolonged closure, one that drags on for months, that is a completely different beast. That's the scenario that could give us a real 1970s-style energy crisis and send oil prices into the triple digits. Okay, so that's the story for oil. But it gets even more interesting when we pivot and look at liquefied natural gas, or LNG. Because in the LNG market, that gap between what you'd think would happen and what's actually happening is even wider. Now, here's the wild part. If you just look at the numbers on paper, the global LNG market is actually more exposed to a Hormuz shutdown than the oil market. A massive percentage of LNG exports, especially from places like Qatar, has no choice but to go through that choke point. So, logically, you'd expect an even bigger price explosion here, right? But nope. Once again, the market isn't freaking out. And why not? It really comes down to 2 things: timing and supply. First, the timing was almost perfect. This whole crisis kicked off just as the winter heating season was wrapping up in Asia and Europe. Demand is naturally at its lowest point. And second, the global LNG market is on the verge of being absolutely flooded with new supply. Just take a look at this chart. It visualizes that supply wave perfectly. Look at the difference between recent growth and the projected growth from 2025 onwards. It's huge. The market is heading into a period of massive oversupply, which means the whole system is just looser and way more able to absorb a shock like this than it was even a few years ago. Okay, so let's put our trader hats on for a minute. What does all of this mean for people actually watching the prices tick by tick? Well, for them, this situation is being treated not as some fundamental, game-changing shift, but as an episode of really intense, but ultimately manageable volatility. And that distinction is absolutely everything. See, a volatility event gives you these sharp, whiplash-inducing price swings, but they tend to burn out. A structural repricing, on the other hand, is when the market fundamentally changes its long-term outlook on price, kicking off a whole new trend that can last for months. And the market is screaming right now that we are in the first one, not the second. And that's why the perfect phrase to describe the price action is controlled stress. Yeah, prices will spike 4 or 5% on a scary headline, but they aren't spiraling out of control. They react, they reassess, but they don't panic. For anyone looking at instruments like the United States Oil Fund, USO, this means you have to be incredibly careful because these moves are being driven by twitchy headlines, not the start of a new sustainable bull market. Now, this is super important, and we have to be crystal clear. This analysis is for informational purposes only. It is not in any way financial advice. These markets are incredibly complex and volatile. You should always consult with a qualified professional before you even think about making an investment decision. So let's pull all these threads together. When you filter out all the noise, all the scary headlines, and you just look at the underlying structure of the market, a really clear picture starts to form. I think this quote from our source material just nails it. The oil market has shock absorbers. The LNG market is being saved by good timing and a flood of new supply. So yes, this is absolutely a serious geopolitical crisis, but at least for now, it is not an energy market catastrophe. And that, of course, leaves us with the one final trillion-dollar question. The market's defenses are holding strong today. The shock absorbers are doing their job. But the entire outcome really hinges on that one word we keep coming back to: duration. Right now, the market is making a huge bet that this all gets resolved relatively quickly. And if that bet turns out to be wrong, well, then all bets are off.